It is time now for the top picks from David Burrows, the president of Barometer Capital Management. Now, throughout the show, David has been talking quite a bit about what's out of favor, what he doesn't necessarily like right now. Let's find out what he does like and what's working for him. Digital Trust Realty, DLR, on the New York Stock Exchange. You don't hear much about it, but it's I guess it's a real estate corporation in a sense.
Yeah, listeners have heard us talk about REITs for 2 years now, and we got a lot of Canadian REITs, and we like the characteristics of the REITs. DLR is a REIT in the U.S. that owns 102 properties that are, in effect, data centers. So they rent out space to companies to put their equipment that support their cloud computing and their networks. They're on 4 continents. They're 95% occupied. It's highly profitable business because you pack a lot of equipment into a small space. They have been excellent at growing their dividend. You get a 3.8% dividend yield. They'll grow their dividend this year and next probably 11–12% a year. So you compare that to a treasury, that's not so bad. It's a highly efficient business. So we really like REITs. We also really like the U.S. dollar given the current environment, which is why we do have about 50% of our equity exposure right now in the U.S. In our income fund, it would be a lot less, but we do have some exposure there.
So you're favoring more of a domestic company, and that may be one of the better charts I've seen in a long time, a long-term chart.
It's a very steady performer, and frankly, though, if you look at the REITs in Canada or the REITs in the U.S., they are among the best performing stocks in the market right now, and it's because people want yield and they want dividend growth, and these are excellent vehicles for generating that.
You're also recommending Amgen, the biotech, and I should mention you last purchased a Digital Realty at around 76 in July. You bought Amgen at 74 or so in July as well. Tell us about Amgen.
So I guess 2 or 3 months ago we started talking about pharma stocks. We like to look for sectors that have been out of favor for a long period of time and become under-owned, where the multiples have compressed and you're buying good value when you start to see new money get put to work. If you take a look at almost any large cap pharma stock in North America, they are coming out of 10 and 12-year bases. They have lots of upside. The pharma stocks have discounted the patent cliff, and so we talked about Abbott and we talked about Merck. Amgen is interesting because they have virtually no competition coming from generics. They don't have things coming off patent. They've got very strong franchises in cancer and in anemia. They generate about $4 billion of free cash flow this year, so it's about an 8% free cash flow yield. And it's one where there's not a lot of competition, and it's in the right group. So we like the pharma space. This is something I think that makes sense in this environment.
And likely not a company that Canadians would give that much thought to generally, although it's a $58 billion market cap.
But these are very large companies. They got rock-solid balance sheets, and you'll get good, solid dividend growth from it without a lot of economic sensitivity, and there's a lot of risk, based on a changing consumer.
So Digital Trust Realty, Amgen, and you are recommending cash. What percentage do you hold for your clients, roughly?
Look, it really depends portfolio to portfolio, but the bottom line is you can't operate with biases in this business. There are times to be fully invested, there's times to be cautious. We're in the 4th year of a recovery cycle, and in the environment we're in with a low trajectory recovery, they don't go forever. So the job of a manager is to make lots of money in year 1 and year 2, to be cautious a little bit in year 3 when things start to get sloppy, and year 4 is probably going to be a sloppy one. So this started last June. We think likely this correction works through its course over the next few months, and later this year we probably set up for another new cycle. So at this point, cash doesn't make us any money, but it gives us flexibility. And our job now is not to take 2 steps back in a tough market, but to hold firm on what we've made over the last few years and be in a position to take advantage of things when the market starts to perform a little better and the data starts to get a little better.
And just quickly, long term, you're looking at what? You're saying you see a rally coming later, but long term, are we in trouble, or are things going to get better?
I think that you could expect in a deleveraging environment to have muted economic growth. And so you don't want to chase the things that do well in a high-growth environment. You want to do well on things that have defensive characteristics. So if you look at the 1950s, interest rates stayed between 2 and 2.5% for 14 years. What did well? Staples, pharmaceuticals, things that paid low dividend payout, but where the payout ratio rose over that period of time, and that's what we're looking for right now.
All right, that trade is still working for David Burrows. Thanks for coming in. Great to see you.
Thanks for having me.
All right, David Burrows, one of our regulars. As you know, he's been on for years. Our thanks to him. Thanks to you. We'll see you tomorrow night, and a good night for now.